Thinking about investing in stocks but not sure where to start? It might seem complex, but I promise, it's more straightforward than you think. We've all heard those amazing stories, people paying off their mortgage or sending their kids to college, all thanks to smart investments. But before you dive in, it's crucial to understand that what works for your friend might not work for you. Everyone has different goals, timelines, and comfort levels with risk. Today, I am going to walk you through a step-by-step guide to help you start your investment journey with confidence. By the end of this video, you'll have a clear roadmap to making your first investment. First things first, let's talk about you. There's no one-size-fits-all strategy in the stock market. Your personal financial situation, your goals, and your attitude toward risk will shape your unique investment style. So, the first step is to define your goals. Why do you want to invest? Seriously, take a moment to think about this. Are you saving for a down payment on a house in 5 years? Are you building a retirement nest egg for 30 years down the road? Or maybe you're just looking to grow your money over the short term. Knowing your why and your timeline is the foundation of a successful strategy. It helps you stay focused and make decisions that are right for you, not for someone else. Next, you need to identify your investment profile. This really comes down to two things: your risk tolerance and your time horizon. Risk tolerance is simply how much risk you're comfortable taking. Can you sleep at night if your investments drop by 10%, or would that send you into a panic? If you prioritize protecting your money above all else, you're a conservative investor. If you're willing to accept higher risks for the chance of higher returns, you're more aggressive. And of course, there's a whole spectrum in between for moderate investors who want steady growth while limiting risk. It's important to remember, though, that even the most conservative strategy has some risk. In stock investing, there are no guarantees. Your time horizon is when you'll need the money. If you need it in 2 years, you'll invest very differently than if you don't need it for 20 years. A longer time horizon generally allows you to take on more risk because you have more time to recover from any market downturns. Okay, once you know your goals and your risk profile, it's time to create a budget. This is a step you absolutely cannot skip. Look at your after-tax income and figure out how much you can realistically set aside for investing each month. Make sure you account for all your regular expenses: rent, groceries, bills, and any existing debt you might have. It is also a great idea to have an emergency fund set up before you start investing. This should be 3 to 6 months of living expenses in an easily accessible savings account. You don't want to be forced to sell your investments at a bad time because your car broke down. Once your budget is solid and your emergency fund is in place, you can confidently allocate a portion of your income to investing. Now for the exciting part: opening an account. To buy and sell stocks, you'll need a brokerage account. For most people starting out, an online broker, also known as a discount broker, is the way to go. These platforms allow you to trade securities with low or even zero commissions, right from your computer or phone. The popularity of investing has exploded, which is great news for you because it means there's a ton of competition among brokers. This has driven down costs and improved the services they offer. So, how do you choose the right one? When you're comparing online brokers, there are a few key things to look for. First, check out the platform features. As a beginner, you'll want a platform that has an intuitive, easy-to-use interface. You don't want to be overwhelmed by complicated charts and jargon right away. But also look for a platform that can grow with you. As you gain experience, you might want access to more advanced tools and research. A good mobile app is also a huge plus if you want the flexibility to manage your investments on the go. Next, look at the minimum account requirements. Some brokers require a minimum deposit to open an account, while others have no minimum at all. Be sure to read the fine print so you understand all the costs involved. This brings us to fees and commissions. This is a big one. Some brokers charge a flat monthly fee for using their platform. Others might charge for access to premium research or data. And then there are commissions, which are fees you pay per trade. These can range from $0 up to about $10 per transaction. Over time, these fees can really add up and eat into your returns, so finding a low-cost broker is key. Here's another pro tip if you're interested in buying stocks from other countries, like US stocks. Look for a broker that helps you minimize currency conversion costs. Ideally, you want a platform that lets you hold both your home currency and US dollars in your account. This way, you're not paying a conversion fee every single time you buy or sell a U.S. stock. This small detail can save you a lot of money in the long run. Take your time with this step. Research a few different brokers, compare their features and fees, and choose the one that best aligns with your needs as a new investor. So, your account is open and funded. It is so tempting to just jump in and start buying stocks that you've heard about in the news or seen mentioned on social media. But I urge you, please don't get caught up in the hype. The stock market can be very volatile, and making decisions based on emotion or media noise is a recipe for disaster. Every single investment you consider should be carefully evaluated based on your goals, your time horizon, and your risk profile that we talked about earlier. This is where research comes in. As a self-directed investor, you are your own portfolio manager. Developing some basic analytical skills is essential. Let's say you've identified a company you're interested in. A great place to start is by looking at its financial statements. You can usually find these on the company's investor relations website. Look at their revenue, their profits, and their debt. Are they growing? Are they profitable? Then, compare that company to its competitors in the same industry. This is called comparative analysis. It helps you understand if the company is a leader in its field or if it is lagging behind. This research process builds a solid foundation for making informed investment decisions, rather than just guessing. Once you've done your research and you're ready to invest, it's time to build your portfolio. A key concept here is diversification. You've probably heard the saying, "Don't put all your eggs in one basket." That is the essence of diversification. Instead of putting all your money into one company or one industry, you should spread it out. Consider investing in companies across different sectors, like technology, healthcare, finance, and energy. Why? Because different sectors perform differently under various market conditions. If the tech sector takes a hit, your investments in healthcare might be doing just fine, which helps cushion the blow. A diversified portfolio is your best defense against risk. It ensures that a negative event affecting one part of the market doesn't wipe out your entire portfolio. Finally, investing isn't a set-it-and-forget-it activity. Tracking your progress is an incredibly important part of the process. You should regularly monitor your portfolio, maybe once a month or once a quarter. This helps you see if you're on track to meet your goals. It also helps you understand how much you're paying in fees and see how your investments are performing. Monitoring your portfolio allows you to decide if you need to make any adjustments. Maybe one of your investments has grown to be a much larger part of your portfolio than you intended, making you less diversified. In that case, you might want to sell some of it and rebalance. Or perhaps your financial goals have changed. Regular check-ins ensure your investment strategy continues to be aligned with your life. Starting your investment journey is an amazing step towards building long-term wealth. It takes a bit of learning and discipline, but by defining your goals, understanding your risk profile, budgeting wisely, choosing the right broker, doing your research, diversifying, and tracking your progress, you are setting yourself up for success. Thanks so much for watching. I hope this guide has given you the confidence to get started. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more content just like this. Let me know in the comments if you have any questions or what topics you'd like me to cover next. See you in the next video.